Lovely to be part of the beautiful country. And I am Raman. I joined TransUnion TU India FinTech team some 5 years back. That was the time when FinTechs were really growing up, right? They were small there. We also didn't know how they'll shape up, right? But fast forward all this to 5 years, they've created a big dent in the industry, right? They've changed the stereotypes. They've changed the processes, the way the lending is being done. They've uh, they're not just settling in anymore. They are there and they are coexisting with some of the large lenders. Right. So the speakers before me, Andrew, and they spoke about two different things: the macroeconomic trends, how they're seeing the fintech, and spoke about how bureau data is being used. So let me just cover that from an India perspective, how it is being done there. And with that, let me give you an overview of how the Indian fintech industry today looks like. Right. The sunrise chart that you see basically covers the neobanks on the left, then it moves towards wealth techs. There are a lot of digital payments, of course, backed by one of the biggest fintech, which is regulated, national-owned NPCI, which is enabling mobile payments through the phone, which we call as UPI. So all these apps like PhonePe, Google Pay, Paytm, MobiKwik, they're riding big on the UPI platform, which is for payments. Then we've got Payday and online personal loan apps, which some of the big ones being CreditBee, DMI Finance, they all today claim about more than 30, 40 million user base on their platforms. So they've gone big, they've overlapped with the banking industry, and they've coexisted with a lot of other entities. Right. Just to take an example, Andrew mentioned about a company tying up on the taxi app, right? DMI Finance, what they do is any Samsung phone that is being financed out in the country, is being sold in the country, is and the hindsight financed by DMI, right? So this increased the mobile penetration, the ease of buying a digital phone, and the funding is on the hindsight done by some of these lenders. So to his point about coexisting a mobile phone OEM tying up with a lender and bringing it together, including the lending on the platforms for cross-sell and so on, that helps further. Right? We've got SME lending apps, the likes of Indifi, Clicks, what you see on the right are enabling MSMEs, small ticket business loans ranging from about 3 lakh to about 10 lakh in INR rupees. So about 300K to about 1 million rupees, right? Then we've got aggregators who are just on top of all these lending apps, act as a aggregator to lenders, act as a single point of contact to all the consumers when they want to take lending, right? And when it comes to the bureau presence, all of them are converging towards lending. Even the digital payment apps, if you go to a Google Pay now, you will not only be able to transact, but you will be able to see your TransUnion score, and you will be able to see lending offers right there. Right? So they are also converging into lending. We think that fintechs were small. Fintechs were just doing minority lending in the industry. But when we look back 5 years, 2019 till date, you see the bar graph, right? That's the share of personal loans done by the fintechs in the country. So 2023, 63% of the new personal loans were actually originated through the fintechs, not through the traditional banks. Right? So that's a huge volume in terms of disrupting the industry, disrupting from where they came in, back in, and now growing further. So some of the trends that I see is even the traditional lenders have now tied up with fintechs, where fintechs actually get the customers on board and these lenders are able to finance through the back end. Right. Some more trends just to show you how fintechs are growing. The bar chart on the left, you see 2021, The light blue color is the growth of fintechs year on year. The dark blue is the growth of the lending industry as such. So post 2020, 2021 COVID waves that hit us hard, fintechs were reeling under the funding pressure. They were not able to recover loans. But data says that they've grown actually faster than the industry. So digitization actually helped. Digitization is what the consumers are looking for. They don't want to go to a branch. They don't want to wait filing for the paperwork to get a loan. They want instant gratification. They want loans whenever they want it, right? We see loan inquiries coming at 2 in the morning, 3 in the morning. So people are looking for loans anytime in the day now. And that's what the data shows, right? Just to give you another perspective of how they've grown in the last 2 years, we've indexed the originations of fintechs and rest of the banking industry at 100 in 2021. And you see the fintechs have reached 189 while the while the lenders, rest of the industry is at 124. So again, the theme that comes in, fintechs are there to stay, fintechs are going good, and fintechs are disrupting the market that is there. Right. This is just to show you what kind of ticket sizes we are doing lending in. Right. The light blue, the bottom chart, which consumes 60%, is still the STPL, the BNPL. The loan in INR, Indian rupees, is 5,000 rupees. So in dollar terms, that's about $60, $50 to $60 in today's currency. Right? That contributes majority of the loans. But if you see, the ticket sizes are growing. The fintechs are no longer in the BNPL, STPL, whichever word is more popular here. Right? They are not in that small ticket personal loan of 5,000 rupees, a $60 loan. But they've grown. So they've grown to a $300 loan. Right? And if you see the top 3 charts, the orange, green, and the gray, which are there, they are actually increasing over time period. So ticket sizes are increasing. And as ticket sizes increase, the fintechs have realized that they need a more robust, they need a more stronger bureau information, credit behavior of the customers, and not just alternate data on which they're riding. Right? When it comes to a loan, which is 500 rupees, right? $6 to $10 kind of a loan. They still give it away basis some of the consumption they see on the other apps. But when it grows to larger ticket size, they want to rely on more robust, want to rely more on the credit behavior of the consumers. And that's where they start using the bureau data intelligently. In terms of the correlation, that was one of the asks, that how do we see, is India more an urban market or a rural market, how it is spread. So this chart basically tells you what kind of a spread is there in the Indian geography. We cover metro, urban, semi-urban, and rural as 4 categories. And you see whether it's the fintechs on the left side or it's the rest of the industry, they are growing towards the rural and the semi-urban area. The consumers are tech savvy. I gave you an example of a Samsung phone being financed by different lenders. And see, this in turn is helping the entire lending industry. People sitting anywhere, any part of the country, as long as they've got a smartphone, they can apply for a loan and they can get it. I spoke in the breakfast for collections with some of you folks, and I'll cover that, how collections is working around there. Now, all this growth, all this evolution is happening at the same time. Regulators are getting stronger. You see, regulators are tightening the KYC norms. They are tightening the privacy policy, the data privacy. That's where some of the information that can be fetched from a mobile is not being used for a collections or not being used for underwriting also. Right? The first 2 points that I have here on the slide are more towards some of the evolution that's happening in the country now. Right? There's a formation of account aggregation ecosystem. So all the deposit accounts will get aggregated into one. Right? Like you have credit bureaus having the credit information, the account information can also get aggregated at one level. We are working on that. Then with the fintechs, the likes of the aggregators, the likes of the digital payments we saw earlier in the slide, they used to get into a FLDG arrangement. FLDG is first loss guaranteed. So whenever there's a loss that's happening, the aggregators would give a guarantee against that. RBI has come tight on that. RBI is our central bank regulator. Right? They've come tight on that. That has slowed down some bit of lending there. There are crackdown on a lot of illegal apps, some of the illegal practices that were being used by lenders, they have all been shut down. But having said this, all these regulations I'm talking about are back in 22, 23. Right? You still see in the earlier charts that the fintechs have grown, and they've grown faster than the industry. So regulatory changes are coming, the regulatory changes are coming for good, but those lenders who are complying with all of them are seeing a huge demand. One app which is doing an illegal practice would go down, the other would get more number of hits. So there's a huge demand. People are looking for, like I said, instant gratification. They are looking for ease of loan, ease of money in their hand. And RBI, the regulators are tightening them. And as long as they're following all the rules, they're seeing huge demand. Right. With all these clubbed as an environmental in the country, what fintechs are right now focusing on, right? Which probably would be the need going forward everywhere, right? One, they want to focus more on the right customers, right? We saw the chart earlier where they were giving $60 loan, even smaller $10 loan as well, and now they are growing. Now they're growing to right customers, they're growing the ticket sizes, they're increasing the profitability there. So they want to focus on the right customers, one. They want to focus on high value prospects, right? Whoever is quick, they want a lower CAC. Right? Whoever is quick to target, they'll go with that. Whichever can be reached out first without much of a feet on street, they'll go down first. At the same time, they don't want to increase too much of friction for the customers. They want to make it easy. They want to make it super convenient for the end consumers to take a loan on. So that's largely what's happening in the country. That's largely what's being done. My next section will cover some of the case studies on how we've addressed these challenges for the lenders. Right. So with those problems, with those objectives of fintechs, the first case study was to find the good customer, fund the good customers, and get a good portfolio in the book. Right. So what we did was the background to this case study when we were engaging with this client was that they had a huge cost of acquisition. They go out to the market, they reach out to all the potential so-called population in the country, whatever they could reach out to, and then the conversions would be very limited. Sorry, is there a question? No. Okay. Sorry. Right. So they'll reach out to the customers, they'll a call center would call, do you need a loan of this much ticket size? They'll say yes, no. They'll hang around for a long time. They'll ask more details. So hence the costs kept increasing. The response rate was low. The conversions were really low. Right. But what everybody needed at the moment was targeting the right customer. It shouldn't happen that you call up somebody says yes for a loan, and then you reject it basis the bureau score or something. So you don't want a dissatisfied customer as well. So the idea was to get best of the customers, get them at the right time, at the right stage, and grow the business profitably. So industry challenge, low response, no credit data, high cost of acquisition. There were some algorithms being built on alternate data, but that didn't hold well when it comes to credit behavior. And large part of the customer was still not reachable. Right? People have alternate phones, people have two phones. Which phone do you want to reach on what time? All those challenges were there. Right? How we helped this client was by one, giving propensity score. Propensity is the likelihood of somebody taking a loan. Right? Let's say somebody's got an auto loan and his auto loan is about to get expired, then probably it's the right time he can switch for his vehicle and take another loan. The same probably can be used in insurance industry also, right? You know the start date of the auto loan, probably that's the right time to pitch him insurance the next year and the year on, right? You can do credit checks, you have income checks, you got fraud checks. Is somebody changing his address too many times? Is somebody changing his mobile number more than 3 times in 3 months, or more than 4 times in 6 months? Those are indicative of frauds in the industry. So we helped this client by doing certain filtrations, right? We got the entire population tested. We applied certain filters. For simplicity, I just put propensity score and some of the CV algorithms that were applied on the potential base, and we got the finally shortlisted leads from there. So what you see is the conversion charts here. We started with a small sample. We demonstrated on nearly 500K customers. The 500K, after applying the filters, dropped down to 462K, but the bad rates were significantly lower. It was 18%. We applied more algorithms to give them a final base of 250K, nearly 242K is what you see on the slide. And the response rate was higher in this 242K. The bad rate was significantly lower. Right? So instead of targeting the 488K on the top, right, if they would have targeted 242K, they would have seen better conversions, they would have seen lower bad rates. So, ma'am, to answer your earlier question, excuse me, sorry. You were asking whether the trended variables are available on the consumer level. That's how we had used it here. It was all done at the customer level. We dropped down all the customer base. We reached out to the potential, and we saw that the bad rate is lower. The study was done back in 22. We were still on work from homes, and the lender was trying to do big. Today, they thank us, they engage with us because that's how they were able to drive their cross-sell in a large way. Right. What has been used, and Anne rightly described, we use the trended data. We use the CV algorithms, credit vision algorithms, and we got them to find the right customer for their cross-sell offers. What it helped them was the overall behavior in the credit, whether they are a revolver or a transactor. Are they revolving too much on their credit card, or they're just transacting? Right? Probably the hint from this is, if somebody is revolving too much on the credit card, maybe PL is the right product for him, personal loans. Right? The payment behaviors could be seen, the balance magnitudes could be seen. Right? They were, the problem was people take loan, and at that time everything, the bureau history is good. But the second EMI, they default. So what we observed was that the trended variables help there, right? If the balances are increasing, their utilization of cards is increasing, probably a few months down the line, he's gonna be risky. So that's the behaviors we saw. The fifth point, the wallet share, actually helped us identify customers' behavior. Is he switching the credit card too many times? Is he loyal to one company? Right? So his loyalty is an indicator with his credit card behaviors. So these behaviors were used in assessing the customer and getting the right loan offer for them. When we extrapolated this, after a year, we did 10 million with this client. We took the 10 million base, we applied all those filters. We finally got 4 million as a qualified base. We put that on a watch list, we saw how its behavior, and 1 million were high demand customers that we saw. So instead of targeting the 10 million base that they had at that time, they targeted on 1 million, and next 60 days they saw about 67% conversion out of it. So lower CAC, it helped reduce their cost of acquisition and get the right customers on the board. The next case study, sorry, I'm rushing because the ticker is right in front. The second case that we did was on collections. Now, once they had expanded, they had some problems in the collections. While the client I'm talking about here is one of the best in the FinTech space. Having said this, they still wanted to go and understand how they can improve. So the first thing we engage is show them the mirror. We produced the charts. I think colors are quite mixed up. So the top line you see is rest of the fintechs. The middle line you see in Q3 23. is this particular lender. And the bottom line is the private banks we see. The private banks, if you've heard, includes names like ICI, HDFC, and all. Right? So we were able to tell them that they are probably doing good than rest of the fintechs, but when it comes to the private banks, they probably have something more to do. So they were honestly not the worst of the customers to do a analysis on. They were not the best of the customers, somewhere in middle, and that makes me get this case study to you. Right? When we did this analysis, we further bifurcated their base. We applied our credit vision algorithms to get them to do the collections in a better way. Right? When we applied those algorithms, and I'll come to those algorithms list later, when we applied those algorithms, we found that if they would have targeted the 40% base, which is the top right, in 7, 8, 9, and 10 decile, their accounts, their collections would have been a lot better. 62% was the conversion rate on that. Right? So instead of giving the entire 30 plus base or 1 plus base also to collection agencies and spending more on the collections effort there, had they used analytics, they would have been a lot better in collections right at the beginning. Now this data was done on 1 to 29 bucket. It was further tested on the same bucket. We used certain data to train the model. We used certain data to test it out on their base, and we found good results when it came to these buckets. Hence, we came and presented those to them. We did the similar analysis on their 30 plus bucket also. Again, we saw that in 30 plus, if they target the 40% of the population only, through digital means, through a direct contact instead of a collection agency, their conversion rates would have been 73%. So the point I'm trying to drive is when it comes to more intelligent use of the static bureau data, it's there. When you convert it into trends, you see the logic, you see the behavior, and that's how you use it to optimize your cost. You use it to get a better conversion, whether it is on acquisition or it is on collections. Well, these are a list of algorithms. There are a lot of them. In the interest of time, in the interest of the audience right now, I'll not get into the detail, but maybe Anne can help you with some of these algorithms on your portfolio, on your data. So how it helped is you basically have all these algorithms, you divide that as a high, medium, low, and you change your collection strategy based on whatever bucket it is on. If it is towards the higher side, right, then you allocate maybe a telecalling, just little accompaniment from the feet on street. You, when it is in middle, you get slightly more experienced telecallers and little bit of feet on street. But when it is low, then you really need to, then you really need to involve the collection agencies and get feet on street. Right? Then you start sending running notices, you start sending payout legal letters, and maybe get into a settlement only for those customers. So the problem is they were settling for a lot of customers which were willing to pay. Right? But feed on street had the collection agencies, feed on street gives you a different feedback. So analytics help you a lot in reducing your settlements, reducing your restructuring cost for the loans. Right? So like I said, it reduced the spends on the collections. There's a higher cure rates. You see more customers converting into normal, they're normalizing, so getting back into 1 to 29 and 0 DPDs. And of course, it saves a lot of cost when it comes to collections in the rural, semi-urban areas, to be precise. Good. So that's all I had, the industry overview when it comes to the India market, the different uses of credit vision algorithms, different uses of bureau data in acquisition and in collections, both ways. You saw how the conversions have helped in both the matrices, whether it is the growth team or the collections team. Any questions, anything you want to ask me, I'll be happy to attend to.
I think just 2 comments. One is it's good to see the insights of, the targeting from 10 million to 1 million and just being clear using data. What I'm just wondering, where you have thin file and is a big chunk of your population, what models have you put? Because you're almost going in blind. So I don't know what models you've put that we can leverage on, or just test and learn that we can see how to target this group.
Yeah.
And then the second question is, I know in collections you've talked about, how to do the high, medium, low, and there's an emphasis of data and feet on street.
Yeah.
In the India model, I know Kenya has started that. It's just using alternate, what we call them, the debt collection agencies.
Yeah.
How has it worked for you, and how do you see we can best optimize, if that's an ideal model, especially on the digital lending space?
Okay, sure. So on the first point, which was about the acquisition case study, there were a set of algorithms that we applied on the base. I can share that with you. There were propensity scores, there were the risk index, there were about a 15, 20 algorithms that we applied on that base. And we tested, we changed. It is not that this slide came out in one iteration. There were multiple iterations done, understanding taken from the client, and then we actually finalized how to do the segmentation. The case study that was there, it started from 10 million. Sorry, the case study was 500,000, but then when the real testing was done, it was on 10 million. 10 million, then we scrubbed it. We did a so-called portfolio overview of that base. Then we came down to 1 million. Then they reached out to those customers using their telecallers, and the telecallers gave a response that our conversion rates have improved. Today, we are doing similar exercise with another lender, which started their business 5 years after this lender, right? And they are again seeing tremendous value coming out of it. So we are also replicating it within our clients, similar model. There is slight changes. What I'll do is with Anne, I'll share some of the algorithms that were used. Maybe they can test it out on your base also. And that's how it was done. Does that answer your first part? Okay. The second part on the collections, again, the model was any lender, the business guy, the collections guy, what they'll do is they'll just give out the cases to the loan agencies. Loan agencies, the debt collection, ARCs, what they'll do is they'll do a settlement on the ground, and then that's the huge cost. They end up spending 3.5%. In Indian context, 3.5 to 4% means a lot when it comes to the volumes that we are talking about. The change that we saw is not all these customers were willingly defaulters. Right? They probably didn't know how to pay. They were different modes. So it's important for the lender to know which are the customers which are willful defaulters, have an intent issue, and which one were not paying maybe because of lack of understanding and so on. So those behavioral patterns, that classification came out using some of the algorithms which I put it on the slide as well. When you apply those and then give the cases to telecallers, they were able to see different conversions in different buckets. Right? Feet on street, debt collection agencies, I don't know how it works here, honestly, but back home what we observed was they used to do some of the settlement on their behalf. They do some parallel conversations with the customers, the end borrowers, and then the settlements seems to be rising up. When the actual lenders team went on the street to check with those customers, they said, this is what one of your folks said, and that's why we are not paying. Okay. They want the case to come to a 30 plus, 60 plus, and then it goes. So all those things they were able to avoid once they applied certain models. And you understand, right? While you spend cost on the modeling part, you save a lot more cost when it comes to settlement and restructuring. The portfolio quality goes good, the cost of collections is reduced, both the benefits are there. Any other question? Good. Thank you. On that note, once again, I'll thank you to be patient listeners. I thank you to invite me here, have time with me, and I'll look forward for some conversations at the end of this session as well. Thank you. Susan, back to you.